Okay, today we are going to discuss the topic, which is the impact of the global markets to our stock market. Now, I'm sure as an investor, you have realized that our markets is interlinked, right? No one market is single out as a singular entity, but all global markets, financial markets are interlinked. So whatever happened in overseas could also impact our Malaysian market. So today we are going to assess the impact of the global markets to our stock market. So before we begin, just let me go through the disclaimer. So whatever we share on this webinar is only for educational purpose. In no way that I give any recommendation to buy or sell any companies. So if you decide to make any investment decisions out of this webinar, you do it at your own risk. Okay. So today we are very honored to have invited a very experienced veteran in the market, and he is none other than PC Wong, who is a full-time investor, trainer, and author. Now, PC Wong is a full-time investor, author, and trainer. He has more than 20 years of investing experience in Bursa and 12 years of investment experience in foreign markets such as Hong Kong Stock Exchange, Singapore Stock Exchange, NASDAQ, New York Stock Exchange, ASX, and LSE. He is also a best-selling author of 2 books, and his area of expertise includes financial analysis in broad sectors in the resource industry and also REITs. He has 7 years of experience teaching retail investors in local stock as well as global stocks. And academic-wise, he graduated from National University of Singapore in 1989. So today, PC will share with us his perspective on how the global market can impact the stock market. And he is one trainer that I always look up to because he spent 8 hours a day reading financial news, reading investment news, reading geopolitical related news, so that he stay abreast of what is happening around the globe. So without further ado, let me just hand over the session to PC. PC, are you ready?
Yeah, you need to.
Okay, can you try to share your screen? We have a few hundred people on the line today. We even have some guests from South Korea and Indonesia. Wow, that's cool. Are you able to share your screen?
Not able.
Not. Okay, that's interesting. Can you try again?
No. The Zoom icon didn't expand.
The Zoom icon did not expand. What happened? Okay. Are you able to do that? If you still can't, I can help you to navigate your slide.
Okay.
Still unable to?
Yeah, unable to.
Okay. Then if you don't mind, then I will help you to share your slide. You just let me know when you want me to go next, okay?
Okay.
All right. Just give me a minute. All right. Are you able to see my slide right now? PC, are you able to see the screen? Hi, PC. You muted yourself. PC, you muted yourself.
Okay.
Okay. Please go on.
So today we'll look at the impact of global markets on Bursa. So we will be learning what are the notable global indices to watch, learn how do the global market sentiment affect our stock market, learn what are the local sectors that are more sensitive to the global market movement, and learn the portfolio management strategies to mitigate this foreign markets factor risk. Jen, I think you can allow me to share the screen.
Okay, you try again.
Yeah.
Just hang on a little bit while we sort out this technical glitch. Are you able to do that?
Still disabled.
I think it is all right. I think
Okay.
it's
Okay,
okay.
then proceed with yours. So we will be looking at the notable indices that you should watch out for. Now, of course, when it comes to stock indices, it will be the S&P 500 index, the Nasdaq 100 index, Shanghai Composite index. I included the Shanghai Composite because it's much closer to home, and to see whether it can have any major impact on our stock market. Because mostly what we see is from the US side. So let's see whether China has any impact on our stock market. So S&P, Goldman Sachs Commodity Index, that's another market. The S&P GSCI actually is an index that look at the global commodities, but we'll put specific focus on the Brent crude price as well as the palm oil price because these are more closer to home. Now, then we'll also be looking at the S&P US Treasury Bond Index, especially we focus on the 10-year Treasury yield. Now, the US Treasury Bond Index has a very deep impact on the sentiment of investors. For example, a lot of the trade is done in US dollars. So what happened is that a lot of the foreign countries that do trade with US would actually hold US Treasury bills in their as their reserves. Okay, so that's why if the sentiment on the US bond index is poor, then the yield will actually go up because the price of the bond is the yield of the bond is inverse with the price. Okay, so if the price goes down, the yield will go up, and therefore it will affect investor sentiment. And then, of course, it will also impact the US dollar. So here we'll be looking at the DXY, which is the US dollar index. Next. So if we look at it, this is the S&P versus the KLCI. So I've done a chart going back all the way from the 1990s to the current. Now, you can see that during the Asia financial crisis, okay, the KLCI suffered a huge drop, but on the US side, the S&P side, it hardly make any deep fall, okay, on the S&P index, but just a slight fall, and then it's on its way up. Then here we have the Nasdaq bubble burst, okay, which I will show the Nasdaq chart later. And this is post 9/11, okay, where the US enter into another deep trial, okay, for the stock market. But for the KLCI, it doesn't seem to have any deep impact versus what happened during the Asia financial crisis. And even during the dot-com bubble burst, there was a greater drop. But post 9/11, the drop wasn't very huge. Then, of course, we have the global financial crisis, okay, which we see both the S&P and the KLCI dropping steeply together, okay. And next we have the COVID-19 pandemic. Now, the depth of the fall, although was very sudden, but if we measure it by the height of the fall over here, is considered quite small when versus the previous type of a recession drop. Okay, although right now the global economy is still in a way mired in a recession now. But then, even though the economy is not performing well globally, but then the stock market, is moving up. Okay, but we see that the S&P has already reached record high, but KLCI is still, neither moving as high as the S&P, but on a very slow and measured pace, with some up and downs. Okay, so here we can see that 1997, 98 has a greater impact on KLCI, but lesser impact on the S&P. Okay, post 911, lesser impact on KLCI. Okay, and global and regional events, okay, would have a deep impact on the KLCI. Like COVID, okay, global financial crisis, and the Asia financial crisis. Then next, on the Nasdaq, okay, you can see that the dot-com bubble burst, okay, and it has also an impact on the KLCI, okay, but not as deep as the Asia financial crisis nor the global financial crisis, okay, but you can see that the Asia financial crisis have, very little impact on the Nasdaq. The dot-com bubble has deeper impact on the KLCI rather than the 911, post 911. Okay, next. So this is the Shanghai Composite Index. Now, very interestingly, in 2015 to 2016, the Chinese stock market has two major crashes. Okay, the first crash started in the summer of 2015, and the crash number two started in February 2016. But here you see the impact on the KLCI, is very muted. Okay, so in a way, it could be because the correlation with China during that time wasn't as deep versus the correlation with the US market. Next. So on the overall, what are the impact of the indices on the Malaysian stock market? Now, major global and regional events have greater impact on Malaysia's stock market compared to local events elsewhere. So local events is like the China market crash, like the post 911 event, okay? And in a way, sometimes people tend to believe that the local stock market, is has lesser volatility when certain events happen elsewhere. But US recession will have actually a significant impact on Malaysia's stock market, as the US is one of our major trade partners. Malaysia also produces a lot of goods which are exported to the US as well. So if let's say a recession hits the US and consumer actually cut their spending, then the demand for our Malaysian-made products or goods will also be impacted. Okay, and most of all, it is still the largest economy of the world based on the current trend. But a lot of the events like in China would soon have an impact in Malaysia's stock market as well, because of the China is becoming Malaysia's largest trade partner, and also China will overtake the US as the world's largest economy sometime between 2028 to 2030. So although major indices in the US has skyrocketed post-pandemic, we have yet to see similar performance in the Malaysia stock market. So some may equate Malaysia underperformance to current local challenging environment, but one of the main factor is that the US stock market rise has been due to the Federal Reserve. Next. So as you can see, the Federal Reserve have actually been printing money like there's no tomorrow. Okay, this is where the start of COVID-19, 4.15 trillion to 7.69 trillion. So there's a lot of liquidity injection into the market. And this is during the towards the end of 2020. And with that amount of liquidity, US companies are buying back their shares to keep the share value high. Okay, so that's why the US stock market rise has been driven by Fed's easy monetary policy, which allow US corporations to expand share buybacks even as their debt level rises. Now, currently more than 50% of US corporate bonds are below investment grade. Next. So how can one actually execute an index-based strategy? So as we mentioned earlier, the Klci will likely follow suit when major US indices fall. Now, if the US indices fall by more than 5%, then chances are there could be a correction forthcoming. So throughout the, a lot of the gyration in the stock market in the US, is within that, 5% level, and it has not fallen more than 5 since the sudden drop from the COVID-19 pandemic. So the US stock market especially can be prone to sudden sell-off as margin debt has reached record highs. So currently the US stock market margin debt, which means the people are using their stock to borrow money as a collateral and then to reinvest back into the stock market. And right now the US stock market margin debt has reached record high levels. So if let's say there's a fall greater than 5%, then likelihood there will be a great cascading of selling in the US stock market, which would then impact global markets worldwide, including our stock market. So in such a scenario, I think it would be better to find a bottom, allow the Klci to find a bottom rather than executing an average down strategy, as this is akin to catching a falling knife. So sometimes when the stock market starts to fall, okay, we would think that let's average down when it falls 10% or 20%. But if let's say there's a huge event that is occurring, then it is much better to allow the Klci to fall, to see where the bottom is. So, but once a bottom has been reached, wait for the Klci to level off. Okay, sometimes there could be a dead cat bounce. So rather than chasing all the way to the bottom, okay, and it could be very damaging to your portfolio. So wait for the bottom to occur, then allow some time for the Klci to recover to see whether that recovery can be extended or not. So by executing such a strategy, you won't be able to buy at the bottom, but at least you are able to buy close to the bottom. Now this calls for patience on your part, because you must always remember money moves from the impatient to the patient. Thanks. So this is the S&P GSCI index. Okay, so Goldman Sachs is already predicting that the 2020s will be seeing a similar structural forces to those which drove commodities in the 2000s could be at play. Okay, and this is what happened during the early 2000s. Okay, between 2000 to 2008-9 period. Okay, you see that the run up in the commodity index. Okay, it reached a high of 9,323 in 2008. Okay, this is what we call a commodity super cycle. Now, ever since it has fallen, okay, this was in 2011, also due to extensive money printing by the Fed, okay, because you have QE1, QE2, QE3, and then the index actually moved up to 5,589. So right now it's hovering at around 2,276, which if we want to compare, puts it back, almost to the 1990s. So that is why with so much money that is being printed by the Federal Reserve, not only the Federal Reserve, but also the ECB, the Bank of Japan, BOJ, and also the PBOC, People's Bank of China. There's a lot of money that is in circulation. Now, one of the things that people like to say is that inflation is due to price increase. Okay, now inflation is actually the expansion or inflation of money supply. Okay, it's not price increase and therefore we call it inflation, but inflation is actually due to an inflated money supply. So because more money in the market, okay, chasing lesser amount of goods, therefore price being the denominator would have to move up. So because central banks have printed so much money, okay, over the last decade, it is inevitable that inflation would hit the global market and pushing the indices of the various commodities much higher. So if we look at it, okay, from 2002 to 2008 during this period, okay, there was a 2.4 times gain. Then so if we look at it, okay, from current, okay, at this point here, if we were to move back to the 2008, okay, it is 3.1 times. Okay, next. So the commodity super cycle is driven by several factors. Weakness in the US dollar. Okay, some people say US dollar is going to be strong. It won't be, okay, because with so much money in circulation, the US dollar will naturally become weaker against the commodity. But among other currencies, you know, the US dollar could be the cleanest shirt in the dump. Okay, so but if we look at it through the inflationary cycle, okay, the US dollar would actually, the weak US dollar would actually result in higher price of commodity. Now, there's also the green energy revolution, which means converting fossil fuel to green energy requires reinvestment in raw materials. Okay, for example, solar panels, okay, would require more copper, okay, to connect to all the panels, okay, to a storage, to a electricity storage box, okay, and solar panel would actually increase demand for silver, okay. Then we also have China is embarking on massive accumulation of strategic commodities such as oil, iron, copper, etc. Now, what China is doing is actually they're dumping the US dollar to buy commodities because China is seeing that the US dollar over the longer term would actually cease its value to fall further. Okay, then there's a continual build up in the Belt and Road Initiative extending to the African and South American continents. Now that would require building a lot of infrastructure, waterways, and all this would demand demand copper, iron, steel, cement. So there's a lot of all these resources demand because of the build-up of the BRI. Okay, and that costs even, in a situation where the current output of mining of resources, has been gradually slowing down due to whatever good grades of ore or good grades of raw materials that is on the surface of the earth has already been excavated, has already been dug out. So that's why, the cost of mining actually becomes more expensive because they need to go deeper into the earth surface. And that is causing higher price of commodities as well. So of course, there's a lot of talk about the US massive infrastructure plan recently revealed by President Biden. Okay, population growth will fuel demand for consumption, which increases the demand for raw materials needed for manufacturing, because demand for goods will also expand over the longer term. The demand for raw materials will lead to increase in energy consumption, thus benefiting oil. Now, you can't have mining of raw materials, okay, without consumption of energy. And in a lot of mining of resources, oil is actually the biggest cost, okay, whereby it accounts to about between 20 to 30% of the overall cost of the production. So that's why the more demand for raw materials, okay, then the more demand for oil, okay. So with oil still being a major source of energy, increase in demand will be matched by increase in price, thus driving worldwide inflation. Next. So this is the crude oil. Okay, during its height in 2008, it was $141 per barrel. Right now, it's hovering around 61.45. So some economists are saying that we could see another super peak in oil, mainly due to several reasons. Next. Number one, of course, is the weakness in the US dollar. Now, global commodities are traded in the US dollar. Okay, although in other trading done elsewhere, between the like between Middle East and Europe could be in the euro. Okay, like China and Russia have a dual currency system to trade in oil. Okay, now the demand for raw materials will lead to increase in energy consumption, thus benefiting oil. Under investment in exploration due to capex cut arising from the price of oil mired below 60 for most of the period from 2015 and 2020 and transition towards green energy. So this means that oil prices have been so low that a lot of major corporations that are oil producers have been cutting their capex over the last few years. When you cut your capex, that means that there's lesser oil exploration, and lesser oil exploration will lead to lesser oil discovery. And not only that, the low price in oil have already resulted in the destruction of the shale oil industry, as many oil producers fell into bankruptcy. US shale oil producers over the past decade have taken on huge amounts of debt to fund their operations, share buybacks, and dividends. Basically, the US market throughout the last decade has been driven a lot by share buybacks. Okay, they take on debt to pay dividend, okay, which is always ended up with the shareholders holding the bag because they subsequently went into bankruptcy. So there's also potential conflict in the Middle East, South China Sea, Eastern Europe, and continued disruption of supply from Venezuela could create a global shortage in supply. So the no doubt the major, like what happened in the Suez Canal just a few weeks ago has caused, a lot of the shipping industry to lose $10 billion a day. Okay, and that's a huge amount just because of the jam at the Suez Canal. Now, should a conflict arise, okay, in the Middle East, especially in Iran, and Iran has already mentioned time and again that if Iran oil cannot move out of the Strait of Hormuz, then no other ships can, okay, and they are prepared to prevent any of the ships leaving that straits if, let's say, it comes to a war between the US and Iran. Okay, so in the South China Sea, there's still tension. Okay, and also in Eastern Europe. Okay, right now, the Ukraine president has already officially declared war on Russia by stating that in his decree that the Crimea belongs to Ukraine. So right now, both Ukraine and Russia is moving troops to the border. Okay, and all this is because of the need to disrupt the Nord Stream 2 pipeline from Russia to Germany. So that's why there's this conflict, okay, between Ukraine and Russia. So because of all this, with and also the destruction of the shale oil industry, where US used to be the world largest producer at one time, okay, the market is totally unprepared for an oil shock, assuming, there is an all-out war in those very high tension zones. Okay, next. So this is the FOA, Food Price Index, okay, and you can see that over the past few years, okay, this is 2018, this is 2019, and 2020 prices have started rising since May, okay, and it has continued to 2021. Can you see the huge gap, okay, between 2021 and 2019, just 2 years ago, okay? And this is the commodity price indices. You can see vegetable oils, okay, has been moving up, okay? Then dairy and cereals as well, okay? Meat has been a bit well controlled to now, but sugar has also been moving up. So all this is resulting in global increase in food prices across the board, okay? Last year when I talk on similar webinar, I mentioned to look out for commodities, especially the plantation stocks, because a lot of the because of the money printing, it will lead to higher cost in food prices. So now this is being played out. Next. So let's look at palm oil. Now, the height was reached in 2008, okay, and currently we are quite near that area. So if, let's say, at the rate of the food price index is escalating, there's a possibility that palm oil could escalate beyond its 2008 peak. That is due to several events, which I'm going to explain in the next slide. Of course, primarily, again, because most of the commodities are traded in US dollar, when US dollar falls in value, it is only rational that the cost, that the price of the commodity would have to go higher. Now, the other thing is population growth, driving up consumption of vegetable oil. And also there's demand for biofuel to offset reliance on fossil fuel. So that's another area, okay, that is pushing up the price for vegetable oil. Okay, the other thing is that the situation is made worse by the ongoing grand solar minima, which is expected to last until 2040. So the grand solar minima was first identified by scientists in somewhere around 2019. Okay, and by referencing it to the previous mini ice age, which was during the I think 17th century, similar incident, it lasted for about 2 decades. So the grand solar minima will cause extreme weather conditions across the globe, damaging agriculture crops in the process. So in fact, that impact was already seen in 2019 all through 2020, where there's a lot of in the equatorial region, okay, in the tropical region, there's extensive floods and sudden heat waves. Okay, then on the northern and southern hemisphere, there's always a cold shock, okay, or deep freeze, like what happened in Texas recently. Okay, Texas being one of the southernmost states, suddenly have a deep freeze, okay, which disrupted electricity supply for a few days. So this weather condition would actually disrupt a lot of crops once it continue its progression over the next 20 years. Next. So what is the overall impact of the commodity supercycle? Now, the global economy will likely see stagflation, where we have high inflation, low growth, albeit a small initial burst in growth due to extreme low interest rate and QE by not only the Fed, but also the ECB and BOJ. Now, long term, we will unlikely see the type of growth driven by robust economic activities, as global debt growth expands faster than economic growth. Global debt is estimated to reach 365% of global GDP by the end of 2020. Now, this is from the IFF. So in response to the high inflation, Bank Negara may be forced to raise interest rate. Now, any inaction to temper the rapid rise of inflation will result in inflation running out of control, and that would result in the currency value plummeting. So I think what we need to look out for in the coming inflationary cycle, is how Bank Negara may be forced to increase interest rate. So if Bank Negara increase interest rate, then of course certain sectors of the economy could be impacted as well. Next. So Of course, some sectors will benefit, and they are the oil companies, okay, will be the beneficiaries. This includes those with upstream, midstream, and downstream exposure, okay. Plantation companies, especially those with upstream, midstream, and downstream exposure. Agriculture-based companies, including those in the fertilizer and pesticide business, poultry farms, or animal husbandry companies. Okay, these are all related to due to the food price increase, which I think okay would reverberate across many sectors. Now, normally oil is the major culprit for inflation, okay, because oil, as I mentioned, is consumed not only in the economic activities that are like airlines, okay, travel, but then oil is basically every sector consumes oil because as long as there's economic activities, okay. So if oil price increase, then it will begin to spread across all sectors. It will impact from the power generation to the manufacturers to the freight companies, okay, and then freight companies to the retailers, okay, retailers then to the consumer. So that's why increasingly a lot of well-known economies across the world are warning that we could see a repeat of the 1970s stagflation. Now, because so much money has been printed, that stagflation is going to be much worse. But meanwhile, because a lot of the global economies, a lot of the countries are still suffering from the ravages of the pandemic, we could potentially see not a stagflation type, but inflationary deep recession type, okay, of economy. So that is what some global economies are warning against, because it is inevitable in a sense because of the pandemic. A lot of economies are being hit, okay, but by printing more money to lift the stock market but not the economy, then it's also not helping a lot of the people that are especially in the US, yeah, they printed so much money just to lift the stock market. Suddenly the stock market is the economy, but not the real economy, which is actually manufacturing, providing services, and such. Okay, so food processing and consumer-based companies could also do well. Okay, especially consumer-based food companies would be those that are providing those necessities, okay? And then, of course, mining companies. Now, profitable tech companies will do well, especially those related to the semiconductor business, as demand for EVs, IoT, and smart devices increase. So I think the tech companies, those who are profitable with strong balance sheet will be able to thrive, okay? But those who have very bad balance sheet, those would be in trouble, okay? Especially many new tech companies, they rely on continuous funding, okay, to keep the operations up and running, looking at scaling up the revenue, okay, where revenue matters more than the bottom line, the net profit. Then these companies could be in trouble, because if, let's say, inflation is high and we could see increase in interest rate, then the cost of funding would naturally become more expensive. And for tech startup, that could be a challenge. Okay, next. So glove companies will face not only increase in input costs, which is oil, rubber, and chemicals, but challenging competition, as the pandemic has resulted in an explosion of companies entering into the market across the globe. So because of the pandemic, we see a lot of the glove companies, moving up, 2x, 3x, or even 4x at the start of the pandemic. Subsequently, with the vaccine, and then things start to decline. I think not only because of of the expectation of the vaccine, but I think it's mainly due to so many people suddenly wanted to start a glove manufacturing facility. We have property companies suddenly say, hey, glove is the fastest growing sector, let's go into it. Okay, then we have people without the experience but having the money, let's hire someone, to start a plant, and then we go into it as well. So globally, a lot of people move into the glove sector. And right now, with increase in the price of oil, okay, now if we look at during the pandemic, oil was around 30 or $30. Now it's 60 over dollars. So oil actually have increased by 100%. Okay, and this would be a challenge to glove companies, because if commodities price increase, then their margin will be impacted. Whether they are able to increase their price or not is also hampered, because suddenly there are so many participants in the market. It's just like during the lull years, okay, the very slow years of the palm oil industry, because of the super peak cycle in 2008, going all the way to 2008, so many companies, decided to start plantation business and so forth. So what we have then is, overproduction, because not only in Malaysia, but, even in Africa, excuse me, and in South America, companies are actually starting up their own oil palm plantation, and then, the market suddenly becomes very saturated. So when the market becomes too saturated, then the chances are to raise price would become a very challenging factor. Okay, so manufacturing sector, especially those in the automotive sector, will also be negatively impacted. Okay, to captivate consumers, expect discounts and incentives to be offered, resulting in the margin being squeezed. Okay, now in the property sector, resulting inflation in raw materials, steel, cement, copper will push the price of properties higher. Consumer may see properties priced beyond their level of affordability. The other thing is that increase in interest rate, which discourage consumers from buying or investing in properties. Banks will be similarly impacted as well, because the biggest contribution of banks' revenue actually is from the loans. Okay, so if higher the interest rate, okay, lesser people would want to take up loans. Okay, so this will be another challenge for both the property sector and the banks. Now, unprofitable tech and startup companies which rely on debt to fund operations will see increased credit risk. Airlines will continue to see headwinds as cost of operations and financing increase, and consumers tighten their purse strings. Okay, so these are the sectors which I think would be negatively impacted if, let's say, a commodity super cycle, follows what the other economies are predicting. Next. So this is the S&P US Treasury Bond Index. So recently there has been a rise in the US Treasury yield, sparking inflationary concern, okay, as well as potential that the Federal Reserve, okay, would need to increase interest rate. So then the market has been seeing some volatility, especially in the tech-driven sector, where a lot of it, as I mentioned earlier, the funding derives from the borrowing and also investors' interest to invest into the company, which will be hampered if, let's say, there's going to be an interest rate hike. So when bond value drops, it will push the yield as they are inverse of the other. Next. So this is the 10-year Treasury yield. Okay, you can see that it has moved up because there's a lot of concern with all the money printing. Okay, so the 10-year Treasury yield is one of the most frequently used gauges in monitoring the expectation of interest rate hikes by the Fed. Okay, so even investors that are elsewhere would actually monitor this as well. So how do we interpret the rise in the yield? Next. So US have been racking up huge amount of debt ever since the global financial crisis. US treasuries are sold as a debt instrument. Now with US government debt at 28 trillion, investors are worried that the unlimited monetary easing policy by the Fed will result in runaway inflation, pushing their real yield deep into negative territory. Now, what is negative yield? Now, if you hold the money, okay, till maturity, okay, the investors would eventually lose their would lose some money. Okay, that means that if they buy the bond at $120, okay, but it pays only an interest of $10. So when it becomes when it reach maturity, okay, it's based on the par value, which is actually $100. So they actually lose $10 in the process. Okay, so investors and foreign investors in particular are dumping US treasuries because they are very afraid of so much money printing. Now, record issuance of US treasuries have also resulted in supply overwhelming demand. In such a scenario, price being the common denominator has to fall. Now, it is also reflective that investors are unwilling to invest unless the yield is higher. The Fed, being the buyer of last resort, will have to buy up the US treasuries to keep the government funded in order to keep the yields down. If the yields were to revert to normal 5%, it will call into question the solvency of the US government. In other words, the US government will become bankrupt. Okay, when you are looking at US 28 trillion in debt, okay, now assuming that with the infrastructure bill and all the stimulus added in, US government debt, I think over the next 1 or 2 months will be 30 trillion. So at 30 trillion, 5% interest means it's $1.5 trillion in interest. US tax revenue is around 3 trillion. So it means that if they revert into 5%, then what will happen next? Half of the US tax revenue will be used to finance its debt. Okay, and that is why the Fed will never be able to raise interest rate. Now, the Fed won't raise interest rate, but inflation will go up. And what happens next is that the US dollar would devalue even faster. And that's why economists are saying, be prepared for a super cycle in commodities. Next. So if yield continue to rise, US market will likely see a sell-off as highly leveraged US corporations face the prospect of increased cost of funding. Any major sell-off will have negative impact on the local stock market. The US dollar will increase in value versus EM currencies, and this could pose a problem to EM economies which have outstanding debt in US dollar. So this is what happens when the yield rises, okay? So a strong US dollar will result in lower price for commodities. Crude oil and palm oil will likely to trend down. Malaysia exporters will be major beneficiaries, but importers will see higher costs of imports. Nevertheless, given the amount of US government debt, the Fed can never allow the yield to rise above the US government's ability to service its debt. So that is why it will never be able to raise interest rate. Now, Yellen's suggestion that the metric to measure US debt should be based on its ability to pay is a strong hint that the Fed will implement yield curve control and expand QE to limit the rise in yield. So yield curve control means that buying up bonds, US government treasuries to keep the yield down. So that means expanding QE. So all this means that more money printing, okay? And that is why it will the hyperinflation that is soon to come will stem from the Western economies more, because the ECB is also printing itself to oblivion, and so is the US. Next. So this is the Dxy Index or dollar index. Now, if you can see, there's the downward trend. So the peak, okay, was 160.6, 0.98. Then during the during the close to the Nasdaq bubble was 119.37. Then we have the rise during the 2019-2018 of 102.33. So the DXY is in a long-term downtrend, as can be seen by the lower highs achieved since reaching a peak in 1985. So why is the dollar why is the dollar falling continuously? Now, again, it's back to the printing of money. US have been printing money like no tomorrow, not only, in this century, but in the previous century, ever since it takes itself off the gold standard. Now, since 1971, okay, when Nixon announced that the US is no longer backed by gold, the USD is no longer backed by gold, the US dollar has fallen close to 90% in value, okay? So that is why people used to say, during the 1950s or 1960s, a person in US who is working can support the entire family. But right now, people need to take multiple jobs. That is because the purchasing power of the US dollar has continued to fall. And inflation, irregardless whether it's US or in Malaysia, is a tax on the consumer's ability to spend. Next. So what is the reason behind the DXY downtrend? Now, the US M1 money supply has expanded into record territory and will continue to rise as money printing continues unabated. So you can see the parabolic rise here. Okay. Now, US government debt continues to grow exponentially. The Fed will be forced to cap the yields in US Treasury. Now, this is negative for the US dollar. Next. So reason behind the DXY downtrend. Now, more countries are dumping, trade in US dollar. Okay, Russia, China, Indonesia, Pakistan, and Iran are trading among themselves in local currencies, predominantly in the RMB. Okay, and you can see that the US dollar held in reserves has actually fallen to actually 25-year lows. Okay, so central banks are reducing the amount of US dollar held in their reserve. Now, ringgit may strengthen, but not in the same magnitude as the US dollar. Now, that has a lot to do with a number of challenges that we face. Okay, for example, there were we see some shortfall in foreign investment. Now, foreign investment is very important for our country because if money comes into our country, then it will, they need to convert US dollar into ringgit. Okay, and if let's say investment comes into the country, then demand for the ringgit would actually increase, and that would actually help the ringgit to strengthen. But if let's say foreign investment in the country, is not rising to the level that is a reflection of the 1980s or 1990s, okay, then the demand for the ringgit would actually fall. So that is why we do not need to see just how the US dollar behave, okay, but also need to see how relatively the ringgit is behaving among the regional peers. Okay, next. So portfolio strategies to adopt. Now, long-term weakness in the USD is undeniable. Commodities will enter a super cycle. Need to have exposure in commodities, especially plantation stocks, with some exposure in oil and gas stocks. This is in particular because as I've shown you the chart just now, vegetable oil, has been skyrocketing, and also the expected increase in oil consumption okay, in energy consumption, which would actually cause the demand for oil to increase, and coupled with the lack of exploration and such. Okay, so of course, oil and gas stocks, may benefit because of the weakening US dollar, but again, it needs to be reflected in that that company must have strong balance sheet as well. Okay, if let's say a company that is driven, by debt, okay, to actually explore and produce oil, then the chances are the risk would be much higher. Okay, but if let's say the company has a very strong balance sheet, then the challenges would be less taxing. Okay, now a weak US dollar will also result in inflation running rampant. Best hedge against inflation is still gold. Okay, you can hedge a position via the gold ETF. Now, when it comes to gold, a lot of people often think of it as, hey, like last year when I say, look at gold, okay, and true enough, okay, gold went up to 2,000, but then gold actually fell back to 1,700. Why is that? Now, one of the key things that you should understand about gold is that gold is never a kind of speculative bet, okay? It is a hedge against inflation, a hedge against geopolitical risk, and a hedge against economic uncertainties, okay? So that's why gold is important. Now, if let's say gold is not important, then why are central banks across the globe, okay, has been buying gold. Okay, in fact, from 2009 to last year, okay, 2020, central banks have been net buyers of gold. Okay, so if let's say gold is not important, why do central banks want to hold gold in their reserves? Okay, in fact, Russia, has increased their gold holdings over the years. Okay, and so is China. So when central banks are hoarding gold, okay, it's already telling you something of an event in the future. Not only that, okay, the Swiss, one company, Swiss Gold, has reported that the amount of gold that is held by rich elite individuals in private vaults is more than the entire global gold ETFs added together. Okay, so that's already telling you a second thing. Okay, central banks are holding, rich individuals are holding. Okay, the elite rich are holding. Why is that? Okay, now this could only mean that everyone sees that the writing is on the wall, because as money is printed with no intention to pull back, okay, the lever, then currency's value will continue to drop. Okay, and that is why a lot of bullion banks that are managing the COMEX as well as LBMA, they are trying their best to manipulate the price of gold lower. Okay, now there is really manipulation in precious metals. If let's say there's no manipulation of precious metals, JP Morgan would not be charged in the court for they settle out of court against a charge of manipulating the price of precious metals with a $900 million settlement. Okay, so there is proof of manipulation. So the reason why there's manipulation in gold and silver and in precious metals, because they show the weakness in the US dollar, and the US, being the global hegemony, would want to keep the US dollar as the reserve currency. Okay, so that's why it is at its interest to actually keep the price of gold and silver down, okay, so that the US dollar can still have some relevance in the as a reserve currency. But at the rate that is going, okay, with a lot of central banks that are owning gold and rich private individuals are hoarding gold, it is a sign that they see, this will end sometime in the future. Okay, so another thing is that the demand for raw materials will also result in dry bulk shipping. So this sector may benefit from rising commodities price. Okay, last year when I talked also about gold and also the commodity, I think I remember saying that for those who actually wants to see a turnaround, okay, in a company, then I'm willing to take the risk, then Maybach could be one of the beneficiaries. I think when I said that last year, Maybach was trading around 30 over cents. I think right now it has moved up. Just last week, I think I checked, it's in the 50s or something. Okay, so this is the sector that would benefit because demand for bulk shipping would increase along with the demand of raw materials. And not only that, now if we look at the shipping of containers itself, okay, shipping freight charges, all these have also increased dramatically across the globe, and that is driving, giving companies in the freight industry a second win, okay, or not second win, a new win after seeing the the slow the slow demand over the past few years. Okay, the other thing is that global shortage in semiconductor will likely to last for some time. Okay, as shipping is being impacted. Okay, so select companies with strong and capable management team which can grow revenue and net profit, besides a sound balance sheet, okay, is were likely to perform well. Now, the global shortage in semiconductor is not only restricted to, originally it was just the display console, display panels, and all those. Okay, and it all has to do with the $1 display chip. Okay, but what happened was that during the pandemic, a lot of the automotive manufacturers across the globe, they actually slash their production. Okay, especially those in Europe, China, and US. So they slashed their production, and because of the pandemic, there were a lot of work from home kind of arrangement. So there was a sudden surge in the demand for PCs and devices. So what happened was that the production of chips needed for the automotive sector was moved to the electronic sector. So, but what happened was that in Q3 and Q4, China automobile sales actually hit a reverse gear. Okay, from a plunge, it skyrocketed up. So similar situation was seen in the US and Europe, and suddenly a lot of the car manufacturers suddenly find themselves they have not enough chips. Okay, so then they started to demand the manufacturers to support them. So that caused a very that caused some turmoil in the chip industry, and it will likely to persist. In fact, a lot of the electronics companies are saying that they are going to increase price because of the shortage of chips, which no longer hits the automobile sector, but also in the electronics sector. So that's why companies that are in the semiconductor sector could do well this year, because tech giants are forecasting that it will prolong until next year. So, but then, if you select such a company, you must make sure that they are able to, their balance sheet is very, very strong. Okay, then another sector that would do well would be food company. Okay, but need to focus on companies that provide essential food or basic necessities. Okay, companies that are, that are in the luxury sector would would be unlikely to do well if, let's say, we see a hyperinflationary cycle. Okay, because consumer would actually tighten their purse string. Okay, so the other thing is keep 30% in cash to sustain through a difficult period. Now, for those who have gone through the 1970s, during that time, just to share, interest rate then was between was around 15 to 17%. Okay, interest. So that's why, if let's say global economy goes into hyperinflation, most of the central banks will have to raise interest rate to combat, okay, or retain the value of the currency. So that is, during the 1970s, can you imagine, paying, 15 or 17% interest, then that could be very damaging. So, of course, this comes back to what Bank Negara would actually implement. Okay, so looking at the amount of debt in circulation, I think inflation would be very hard to control, because if central banks around the world do not want to burden the consumer with excessive interest on the debt, okay, what will follow then would be, if you don't raise interest rate, inflation would actually run out of control. Okay, it is very simple economics. So if they raise interest rate, then economy would actually suffer. So then whether that an economy that is inflated in value, or whether an economy that is allowed to find its way, okay, through the proper using the proper tools to manage it, okay, so that it will not be bad, but giving it time to recover. Okay, but we did recover, from the 1970s, and we become quite a powerhouse during the 1980s. So it much depends on what the next steps will be. Okay, and my concern is that because of the huge amount of debt that is in circulation, then it makes the thesis of raising interest rate to combat inflation becomes very burdensome to the consumer. And just some weeks ago, I read that the household debt, okay, to household debt has already risen to 90%. Okay, so in total, I think Malaysia total debt to GDP is still in the 200+%. Not as bad as in China and in US, where it's 300%. But at 200% is also very difficult to manage. Okay, if let's say inflation hits us very hard, on the economy. Okay, so next, that's all I have. Shane, back to you.
Okay, thank you so much, PC, for sharing with us your research. I think it's a very mind-blowing session to many. I think you cover quite a macro view of the global economy and its impact, possible impact to our market. So thank you so much, PC. So if any questions you want to ask our speaker today, please write in the Q&A box, not the chat box, so we can easily manage your questions.